Hi, everybody. Welcome. Thank you so much for joining WHYY. We are NPR. We are Greater Philadelphia's NPR and PBS station, and we are going to get started with today's program. My name is Adrienne Webb-Schulman, and I am WHYY's Plan Giving Officer. I am very fortunate to work with many of you who are electing to include WHYY and public media in your legacy plans, and I'll be your host today. We know that many of you turn to WHYY as a source of news, information, and entertainment. And in that vein, we are really proud to bring you today's webinar, which is about donor-advised funds. We're calling today's webinar Demystifying Donor-Advised Funds, and we're going to specifically discuss how you can organize and optimize your philanthropic giving. We do hope that some of you will consider including WHYY in the charities that you elect to support through your donor advised fund, and that you might join our Y Circle community. The Y Circle is an amazing community of members who elect to support WHYY above the membership level and deeply believe in the mission of public media. So before we get started today, I do have a few short housekeeping notes just to make sure we're all on the same page for the program. So first of all, this program is being recorded, and we will be sharing out a link to the recording along with slides after the program in the next few days or so that you're able to watch the program if you miss any part of it. I also am happy to share that we will be providing you the contact information for Bryn Mawr Trust, who are our partners today. It's important to note that Bryn Mawr Trust is not sponsoring this workshop. This is really an opportunity to get some objective information from someone who's an expert in the field and is happy to provide these tips about philanthropic giving to the WHYY community. Third, thank you so much to those of you who submitted your thoughtful questions in advance. We've received a lot of really, really great questions about donor advised funds. We're going to cover many of those questions during the program, but we also encourage you to submit your questions in the Zoom chat. We will be doing some Q&A towards the end of the program. We may not get to every question, but of course, we're going to provide you with Bryn Mawr Trust's contact information, and you can let us know if you have additional questions and reach out to Bryn Mawr Trust directly with those questions. Finally, we will be sending out a survey after the program by email and also in the Zoom chat. Surveys are really helpful for developing our webinar programs and also helping us know what topics you're interested in. So we really would appreciate it if you would take the time to give us the feedback and help us understand how we can improve our programs moving forward. So it is now my pleasure as your host today to introduce our guest speaker, Elizabeth Baron Wagner, who is Senior Vice President and Director of Institutional Wealth Management at Bryn Mawr Trust. Elizabeth has nearly 2 decades of experience advising families on long-term charitable strategies. She also works with many different nonprofits in our region on sort of their long-term sustainability and helping them understand how to build up endowments and those kinds of vehicles. Elizabeth speaks frequently on charitable giving topics nationally and also regionally, and is an expert in donor advised funds. Previously, Elizabeth was the Senior Vice President and Chief Philanthropy Officer at the Princeton Area Community Foundation, and she is recognized as a certified fundraising executive and has several certifications in the field of philanthropy. She's very active in her community, serving on several boards, including the Princeton Regional Chamber of Commerce Foundation, and we are so grateful to have her here with us today. We have a lot of material to cover, so Elizabeth, thank you again for joining us, and I'll hand it off to you to get the program started.
Adrienne, thank you so much, and thank you all for being here with us today. I'm really excited about this topic, and I'm really excited about this forum. I will tell you, I'm one person who, like many of you, grew up listening to WHYY. It was my childhood alarm clock. And so that makes this morning's, afternoon's presentation especially fun. Philanthropy is my favorite topic. You might ask, what is a director of institutional wealth management exactly? that we should be talking about donor advised funds. So let me tell you a little tiny bit about me. Throughout my career, which started out in nonprofit consulting, moved to a community foundation, and now is at Bryn Mawr Trust, I've really only ever done two things. One is helping philanthropists get to impact, whatever that means to them. Impact is different for each one of us, and philanthropy is deeply personal. And so for my full career, I've spent a lot of time working directly with people who want to make a difference in their communities, especially in ways that are local and high impact. And we'll talk a lot about that today. The other piece of my work is working directly with endowments and foundations, also focused on their mission, figuring out how we get to long-term sustainability and help them build the future that they envision. So we'll start digging into the material. We'll start by talking about what does it mean to demystify donor advised funds. Why are we demystifying them? Well, donor advised funds have become very, very popular over time. And so you may have a number of questions about how they work and what they are. It's my hope today that you will use the Q&A function to give us some of those questions. If we don't get to them during the session, please don't be shy about asking. I do think that giving is a deeply personal choice. And so you may have some questions that you don't necessarily feel comfortable putting in the chat box. And so if while we're demystifying donor advised funds, you find that you have something to ask that maybe doesn't fit in this broader context, you're welcome to get in touch at another time. WHYY will share my contact information, and I'd be happy to help you think through how a donor advised fund might work for you. So let's dig into the next slide. What's a donor advised fund? It's a flexible tool that works differently for different people, but primarily is designed to make giving easy. Here you'll see a list of all of the things that donor advised funds can do. And I said all, but really this is not all the things donor advised funds can do for us. One of the things I like about donor advised funds as a vehicle is that they've become popular in recent years because they meet the giving needs of nearly every kind of philanthropist. One thing that's very interesting is that we used to see private foundations created by people who consider themselves serious philanthropists or who had a lot of assets to put into their philanthropy. Not today. Today, I see donor advised funds really as the premier vehicle for many, many philanthropists. They help us keep track of our giving. You know that moment when your alma mater calls and says, will you give this year? And you think, didn't I already give this year? A donor advised fund is one really simple way to keep track of your giving all in one place and to look up very easily, did I give to my alma mater this year? It's also a way to help you manage the tax implications of your giving and hopefully maximize the tax deductibility of your giving. And we'll talk more about that as we dig in. Increasingly, I'm seeing the trend of people working with their families within their donor advised fund. For some people, that's working with children and grandchildren. For other people, it's more extended groups of family and friends who want to give together and have impact in their communities. I also increasingly see donor advised funds used by people who are saving up for a big lifetime gift. And they are a tool that works pretty nicely for that because at least right now, there aren't any limitations on how long you can keep charitable funds in a donor advised fund. And then here's the last piece that I think people have really responded to over the last decade. There's something wonderful about the idea of private foundations, and that word private just sounds as if it really provides a great screen of anonymity so that no one can see your giving. But the truth is that private foundations over the years have become extremely public. And many people who care deeply about privacy have transitioned their giving to donor advised funds because there is much more privacy available to donors. So if you are a donor who wants to give, but who doesn't necessarily want to get a lot of spotlight for your giving, a donor advised fund might be a good vehicle for you. So let's go to the next slide and we'll talk a little bit about donor advised funds today. There are some basic facts that might be helpful for you to know. All of these are taken from a report that the National Philanthropic Trust, which manages and holds donor advised funds here in the greater Philadelphia area, releases every year. And so these come right out of the 2021 report. They're the most recent information available about donor advised funds broadly. And I should say here, you'll start seeing the acronym DAFs or DAFs frequently in the slides in front of you. That's because donor advised funds is really too long to say. And so when you hear DAFs, what we're really talking about is donor advised funds. So over the course of last year, we exceeded 1 million individual different donor advised funds nationwide for the first time. It's pretty interesting. That means 1 million families or philanthropists have decided to use this vehicle for their giving. The total assets in donor advised funds are just absolutely huge and grow larger every day. And when I said there was great privacy in donor advised funds, you might be wondering why. Then can I tell you how much money is in them? Well, they do report in the aggregate. Donor advised funds, as we'll talk about, all live within a public charity 501c3 structure, and they all do tax reporting, but they don't report on the activities of each individual fund. Instead, the donor advised fund sponsor reports on the activities of all of the funds in an aggregated way. And so we know how many assets have flowed into donor advised funds over time. And that 160 billion number is a huge reservoir of charitable energy just waiting to be released. The average size piece is really interesting. When the National Philanthropic Trust does the averaging, they average donor advised funds that come both from what we call sort of the commercial donor advised fund. That's the Vanguard Charitables and the Fidelities and the Schwabs and other financial institutions, excuse me, including Bryn Mawr Trust. And it is also donor advised funds held in other places, including community foundations. And so I just want to highlight that this average size is a little bit misleading in that the average donor advised fund in one of the commercial donor advised funds tends to be smaller. And the average staff at a community foundation or other local sponsor tends to be much larger, usually around $250,000. And so you'll see that in some of these institutions like community foundations that offer donor advised funds, we start to see larger donor advised funds, mostly because those are people who are giving locally. They're very engaged in their community. They know exactly where their money is going, and they're really directing philanthropy in a very specific and targeted way. So here's some really interesting numbers about generosity in 2020 alone. And as many of you know, 2020 was a very exciting year for generosity. When we look at a study published by Giving USA, which every year puts out the numbers of dollars spent on philanthropy by non-public sources in the country, we found out that 2020 was a year where philanthropy took a dip right at the very beginning of the year. And then as the pandemic got underway, philanthropy just roared onto the scene. And so we would expect that these 2020 numbers would be a little bit higher than a traditional year, right? Probably they were influenced somewhat by all of us figuring out that there was real need for our giving in 2020. But nonetheless, nearly $35 billion in grants coming out of donor advised funds and going into community organizations just in 2020. What an avalanche of generosity. And indeed, nearly $48 billion in contributions going into donor advised funds. That is saving up for future charitable gifts. So 2020 was a very generous year. Let's flip to the next slide and we'll talk about how donor advised funds work. We're going to start in the top left corner on the white circle. And here's where it gets interesting. We talk about contributing any asset. Donor advised funds, as a way to organize your philanthropy, are also very easy to work with when you think about what asset do I want to use to fund my giving. And you can use almost anything that has value to start a donor advised fund. And here's what happens right away. Because donor advised funds are 501c3 public charities, that is, they're just like a soup kitchen in their structure. They're just like WHYY in their structure. You get a tax benefit for your gift to your donor advised fund right away. And so that means that you can contribute any amount in any year and get the full benefit of your tax deductible contribution in that year, even if you don't necessarily send grants out from your donor advised fund to other charities during that year. So that's a unique benefit that donor advised funds offer, the ability to time your charitable deductions in a way that's helpful to you. Once you've gotten your tax benefit, you get to think about, what do I want to do with my charitable fund? A lot of people opt to get some advice, whether they use someone internal to the donor advised fund, whether there's an advisor there who can help, whether they use someone like me, who's a wealth advisor who spends a lot of time working with people on their charitable choices, whether they use an outside philanthropic advisor, or whether they simply seek advice from family and friends, right? Most of our charitable giving doesn't happen in a vacuum. We collect information, and using that information, we make an informed choice. And so typically what happens is after people contribute the asset, they think for a little bit, but eventually we get to the point where someone with a donor advised fund is going to recommend a grant. What does it mean to recommend a grant? Well, here's what it means. And we'll talk about this a little bit more in future slides, but it means that you're going to suggest that a grant be made from your donor advised fund to a specific organization of your choosing. And you're going to suggest the organization, you're going to suggest when the grant should be made, and you're going to suggest the amount of the grant. But the donor advised fund sponsor does have to approve that recommended grant. And in practice, most of them do so every time so long as you're making a grant to an approved 501c3 charity that is on the IRS's list of organizations that are in good standing. And here's how they find out. Once you've recommended your grant, the organization holding your donor advised fund will do some due diligence. What does that mean? It really means going back to the IRS's list of approved organizations and making sure that the organization you have suggested is one that's on that list. Presuming that it is, typically things move very quickly on to the grant award, which is when the donor advised fund sends a check, or increasingly sends money electronically right to the organization, and your grant is complete. Why is there another arrow leading back to contribute any asset? Well, that's because most people who have donor advised funds don't make just one contribution to the donor advised fund. Most people find that it's a sort of a circular process in that they spend down the donor advised fund, add more, find over time that there are other assets that they want to use in a charitable way, and so they add them to their donor advised fund. So for most people, the decision to set up a donor advised fund is not the only decision they'll make along the way. But once it's set up, they'll find that over time, there are ways that they can be charitable and assets that they can add that will cause them to go through this process again and again. So let's take another step forward in the slides and talk about what you can contribute to a donor advised fund to get it started. If you want a donor advised fund, you can put a wide variety of assets in, as we talked about. Of course, you can use cash. Cash is a really interesting asset to use because it is these days 60% deductible when compared to your adjusted gross income, right? Or you can use appreciated securities. I see cash used least frequently on this list, largely because for most people, it's a little bit less efficient from a tax perspective. Appreciated securities tend to be quite efficient. And here's how that usually works. When people contribute appreciated securities, they'll look for a share of stock or a share in a mutual fund that they have owned for quite a while that has significant capital gains. And they'll gift it to their donor advised fund. Donor advised funds are public charities, they're 501c3s. And so as a result, they don't pay tax. And they do not have any obligation to pay tax on the capital gains, nor does the donor. So the donor is able to make a gift of not only the original cost basis in the security, right, what you paid for it the day you bought it, but also all of the gains along the way. And not only that, but the organization gets a much bigger gift as a result, right? So you skip the capital gains tax and you give a bigger gift to the organization. That is why I find appreciated securities are used very frequently by donors to donor advised funds. But there are lots of other assets. I will tell you this list is only a partial list. Years ago, I transacted the sale of the site of a former gas station in a little old town in New Jersey. And we've transacted exotic animals, button collections, all sorts of things that have value. So you can contribute almost anything to your donor advised fund. Some of the really creative ideas that I have seen include business owners who hope that someday when they sell their business, they'll be able to take a share of the business, put it in a donor advised fund first. And this is where you will, of course, need to seek tax and legal counsel. But put a share of it in a donor advised fund before they make a commitment to sell the business. And then once the business is sold, A portion of the proceeds flows into the donor advised fund, generating both a tax deduction for the donor and a lovely charitable fund, and a moment when the donor is finally able to liquidate the business and really do something for their community. So lots of creative ideas of assets that you can put into a donor advised fund. Let's skip to the next slide because I want to talk also about what you can't contribute to your donor advised fund. And I know the first item on this list frustrates quite a lot of my clients, and it may frustrate some of you. There's a wonderful opportunity to make qualified charitable distributions from our IRAs. If you're 70 and a half or older, so you don't even have to be old enough to have an RMD, right? That's 72 and a half. But if you're 70 and a half or older, you can take a chunk of money from your IRA up to $100,000 per year and have your IRA contributed directly to the public charity of your choice. But you can't contribute it to your donor advised fund, unfortunately. And so many people who think about using donor advised funds for charitable giving are also people who have retirement accounts that are significant and who hope they can use their retirement accounts to fund some of their contributions to the donor advised fund. And so this is always a disappointing moment in the conversation when I talk with clients and they say, well, so can I use my RMD? And we say you can do it if you're contributing directly to a 501c3 public charity, but not to a donor advised fund, even though they're also 501c3 public charities. So a complicated little moment here. I want to also point out one other thing. If you have made a commitment to an organization that looks like a pledge, right? If you've said, I will give this much, I personally will give this much to the organization, and then you ask your donor advised fund to use an asset you've contributed to fulfill that pledge, that's not permissible. If your donor advised fund happens to make a gift in the same amount without a commitment to fill the pledge, that actually is okay. But if you've made a specific pledge to an organization that involves specific assets, you cannot run that through your donor advised fund. So just a couple of things that you cannot use your donor advised fund for. Donor advised funds are very interesting in that they're a little bit more restricted in terms of private foundations, right? Private foundations can do all sorts of things, including make gifts directly, charitable gifts directly to individuals. They can make scholarship contributions directly to individuals. Donor advised funds can't do that. These two complicated spots do mean that there are some things you can't put in your donor advised fund or ways you can't use your donor advised fund. But on the whole, the donor advised fund model is so much more flexible than the private foundation that I think it makes up for some of these things that you can't use the donor advised fund to do, or that you can't contribute to a donor advised fund. So I want to talk about why there are some of these restrictions on a donor advised fund that don't always apply to private foundations. So let's talk about whose donor advised fund is it anyway on the next slide. When you make a gift to a donor advised fund to start your own fund, you get to do a bunch of things, right? You get to name the fund, you get to start to think about how you're going to use it. But it's interesting, it really isn't ours. So when I make a gift to my donor advised fund, I can't take that money back and say, I changed my mind. I don't really want to make that gift after all, right? They're irrevocable. Once I've gifted into my donor advised fund, do you remember how we looked at the circle chart and we said, once the gift goes in, I get a tax deduction. Well, because I've taken my tax deduction already, I can't take that gift back, right? That it now belongs to the donor advised fund. And when I get a charitable deduction for gifts that I make to, the WHYY or the soup kitchen or a homelessness charity or something else, those gifts belong to the charity. And in much the same way, when you gift into your donor advised fund, the assets that you put there in exchange for your tax deduction belong to the donor advised fund sponsor. And I just want to clarify that legally ownership shifts from you to the organization sponsoring the donor advised fund. How then is it that you can make grants out of your donor advised fund? Well, you as the donor retain the right to advise the donor advised fund. And what does that mean? It means you make all of the choices about grant making. And in some cases, it means that you even can make some choices about how the dollars are invested over time within your donor advised fund. And so practically, the donor retaining the right to advise means this. You can suggest a grant of any amount to any 501c3 in the country, and you can be reasonably certain that it will be paid out exactly as you have asked, so long as it meets the IRS's requirements. And that's what that advisory right is. In practice, it's a little stronger than it sounds, right? Most donor advised fund sponsors would never turn down a request made by someone who's created a DAF, so long as that request is legal, is able to be implemented. And so remember that you've gifted the asset. It's not ours anymore. We don't have control over it, but we do retain that advisory right. This is maybe the most complicated part of donor advised funds. So where can we get these DAFs on the next slide? Community foundations have a lot of them. I ran a donor advised fund program at a community foundation for quite a while. They're interesting because community foundations are very place-based, right? Places like the Philadelphia Foundation or Chester County Community Foundation or Delco Foundation. Those are organizations that really care about a specific area. And if that specific location is important to you too, they can be wonderful partners. If you have a wealth manager or an investment manager, likely they have a relationship with a donor advised fund sponsor, as we do, and can help you get a donor advised fund. And one of the benefits sometimes of working through them is that if you have particular preferences about your investments, having the same team work on your donor advised fund can sometimes be helpful. Increasingly, I'm seeing donor advised funds available through universities or other large charities. So for example, frequently when a donor advised fund is available through a university, the rule will be that at least 51% of what you put in that donor advised fund has to go somewhere within that university, but the remainder, the 49% or less, can leave the university and go somewhere else. So it's interesting to see there are different rules depending on where you find your donor advised fund. And then increasingly, we do see that employers are sometimes able to offer donor advised funds. In fact, Bryn Mawr Trust did this just a couple of years ago, partnering with a local organization that offers donor advised funds through employers, which was really exciting. And for us, that was really nice because it meant we could offer a donor advised fund without any minimums. And all of our employees could use a donor advised fund in whatever way felt right to them without having to meet a financial minimum just to get into a donor advised fund. So lots of different places to get a donor advised fund. And your job is to figure out which one of these is going to be the right fit for me. And a lot of figuring out that right fit is about how much service do I need, right? Do I care most about how my donor advised fund is invested over time? Or do I care most about getting good ideas regarding organizations to grant to that are in my community? Or do I care most about having someone who can help me administer this and I want to give them a list every year and they're just going to get the grants done, right? What is most important to me about my donor advised fund? And figuring out the answer to that question will lead us to which one of these is going to be the best fit for each one of us. And again, giving is deeply personal. Donor advised funds at different kinds of organizations do have sort of different flavors, different service experiences. And so you'll want to figure out which one of these is the best fit for you before you commit. So let's talk about where you can make grants with your donor advised fund. What kinds of organizations can I grant to? So always you can give to every 501c3 public charity in the nation. You also can give to houses of worship. So as you all know, houses of worship don't file the form 990, the tax form that nonprofits do file, but typically really any house of worship is going to be eligible. Schools, even if they're not traditional 501c3s, typically you can give to them through your donor advised fund, although that doesn't mean that every part of the school will work, right? Affiliated organizations like PTAs, typically you cannot give to some of those through your donor advised fund. So you have to figure out what kind of organization. But if you're giving directly to a school of any kind, typically you can do that through your donor advised fund. Frequently you can gift to municipal agencies as well. And so That's really any part of that municipal ecosystem. But what I see most frequently are things like libraries, parks, recreation departments, those kinds of grants made from donor advised funds directly to municipalities. What you will find is that while you have a wide choice of organizations to grant to, the donor advised fund sponsor may impose some limitations. We talked briefly about how, especially if you're using a university, you may have to gift a certain percentage within that university. There may also be a minimum requirement, right? You might find that they will not make a grant of less than $100 or less than $250 or something. So important to ask about that before you set up your donor advised fund so you know what you're getting into. Let's go to the next slide and talk about what we can't grant to using a donor advised fund. So this is really interesting, and we're going to spend some time, we'll linger here a little bit because there's a lot of meat on this particular slide. Why can't we give to individuals? Well, that's a tricky problem, isn't it? So a lot of times we find that there's someone who we see in our communities who could use a little help. And wouldn't it be nice if we have a donor advised fund to be able to gift directly to that person? But unfortunately, the IRS requires that gifts to individuals be part of something called a charitable class. That is a group of people defined by an event or by specific demographics. And donor advised funds cannot create those kinds of charitable classes. They can gift to organizations that serve people within charitable classes, but they can't make gifts directly to individuals. So no matter how deserving someone in our communities might be, we cannot make a gift directly to them, even if they've experienced a personal tragedy. So what does that mean? It means all those GoFundMes that you see that you want to contribute to have to come out of your personal checkbook, right? They can't come out of your donor advised fund. A second example is anything that has a personal benefit, right? And what do we mean by personal benefit? We mean, for example, when you buy a ticket to a charity event and you attend that event and they serve you dinner, the dinner is a personal benefit, right? You've gotten something in exchange for your gift. While your donor advised fund, because you got a tax deduction for it and it's designed for charitable use, is not intended to give you any personal benefit. And so you can't buy things like event tickets through your donor advised fund. You also can't do things like participate in charity auctions, right? So for example, if you were to attend an auction and you committed to buy, for example, the item that's a week away on some lovely island that we would all like to be on right now, using someone's vacation house, you cannot fund that through your donor advised fund because of course you get the benefit of using that vacation house. There also are some more complicated types of organizations to think about. So 501c3 organizations, as we talked about, are always okay in terms of granting out of your donor advised fund to a charitable organization. There are a number of different kinds of 501c organizations, though. There are 501c13s, for example. They're an easy example. Those are cemetery associations. And there are reasons that donor advised funds can grant to them and reasons that they can't. And so generally speaking, if you're gifting to, you intend to gift to an organization where there might be public benefit, right? Grandma is buried in this cemetery. You cannot gift in a way that gives you that personal benefit. So what I mean by that is you cannot have the donor advised fund send a check for maintenance of grandma's grave. But with some types of 501c, we'll call them not three, organizations, you are able to make grants that have a benefit to society at large. They're educational in nature, they're charitable in nature. So for example, you often can give to the cemetery where grandma is if you give generally to the cemetery and you say, this is just for ongoing beautification, right? You can do that. And so a lot of these more complex transactions are ones where it makes sense to call whoever is holding your donor advised fund and say, I'd like to give to this type of organization. How can I do that in a way that is permitted through my donor advised fund? Now, there are a number of other 501c organizations where I have here tax exempt is not equal tax deductible that do not pay tax, but that are not eligible to receive monies that have gotten a charitable tax deduction, right? And so those are their two examples here, right? You know, chambers of commerce and membership organizations, organizations that are formed primarily for the purpose of advocacy or lobbying activities, right? Those are the kinds of organizations that you cannot gift to through your donor advised fund. And what does that mean? It doesn't mean you can't give to them at all. It means you have to write a check for those or use another source of funds. So you can see the vast majority of types of charitable organizations are things you're going to be able to give to using your donor advised fund. But there are some of these exceptions, and it's important to think about your own giving and think, are these things on the list of items I can't grant to, things I do regularly? And if they are, how does that impact my thinking about building a charitable budget over time? Do I need to hold some back from my contributions to the donor advised fund to fund my giving in these other areas where it might not be charitable, it might not be deductible, but it still feels important to me? So think about this as you're building your own budget for this. Let's hop to the next slide and we'll talk a little bit about tax considerations, because there's always a tax conversation when we talk about donor advised funds. The first strategy that I see people using, and this has been true since the Tax Cuts and Jobs Act of 2017, is a bunching strategy. And bunching really is about making certain that you get the most benefit from a tax perspective for your charitable contributions. Sometimes it happens that all of the things that we can itemize don't add up to more than the standard deduction. And so when that happens for people who are charitable, often they start to think about, can they bunch their deductions, their giving rather, so that they, for example, give the amount they would have given in charitable gifts across 3 years in 1 year, so that they can itemize on their taxes in that 1 year with the much larger gift amount, the 3x gift amount. And then in the next 2 years, they will not make contributions to charity because they have already done it. They front loaded those contributions, and they will take the standard deduction in each of those 2 years after itemizing in the year that they bunched all those contributions. When I see people bunching contributions, the next thing I hear from them often is, I'm not comfortable giving all the charities I support a 3x gift in 1 year and then giving them 0 in the next 2 years. And that's a very thoughtful perspective for a philanthropist to take. And typically this is why I see people using a donor advised fund, because when you're bunching and it doesn't feel right to do that 3x gift to all your favorite charities in 1 year and do nothing the next 2, frequently I'll see people put that 3x gift into a donor advised fund and then parcel it out a third each year until they have gifted to the organizations they care about in the same way they would have, but they've been able to time their tax deduction in a way that makes the most sense for them. So that's really interesting opportunity, I think, for donors who are typically not able to itemize in any 1 year, but who would like to get more of a benefit for their charitable contributions. That's a little piece of that timing on the next bullet. But the other thing I want to talk about is income planning. What I see quite frequently, and of course, this is something that you should talk with your own tax advisor about in terms of your own personal tax landscapes. But I see quite frequently that people who are in their highest earning years, typically towards the end of their career, at a time when they are just providing enormous value and being compensated quite handsomely, frequently those are years when it's helpful to be able to time some of these charitable deductions and some contributions that would create charitable deductions. And so sometimes I find that people who are in those high income earning years would like to create a large donor advised fund now in the years when they have pretty high income. That generates some nice tax deductions during those years. And then once they retire and their incomes are lower, they use the charitable funds squirreled away in the donor advised fund to fund their charitable giving well into retirement. And that's a nice strategy sometimes for people who intend to be very charitable, but who will see a big discrepancy between their income in their highest earning years and their income in retirement. I also see always when appreciated securities or other highly appreciated property is being considered as an asset to contribute, conversations around capital gains. And we talked briefly about this before. But in short, frequently we do own positions and hold them over time and end up with quite significant capital gains in our investment portfolios, and certainly someone who's been invested over the last decade or two could be looking at pretty significant capital gains. And so in terms of managing those capital gains, using some of them to generate a nice tax deduction sometimes is a way to slowly unwind more concentrated positions in which we have a lot of capital gains and also fund our charitable giving at the same time. And we talked already about qualified charitable distributions and how they can be part of your RMD, but you can't put them in a donor advised fund. And so you're wondering, why is that coming up on the donor advised fund tax consideration slide? Here's why. Many people who are interested in using donor advised funds are also people who are attracted to and see some benefit from that qualified charitable distribution strategy from an IRA. And so I want to encourage you that if you're one of those people who could use either of those strategies, talk specifically to your tax advisor about which one is a better fit for you. I find often I'm talking to people who could use both and maybe will use both, but who need some help planning out how these are going to interact. And this is the place where good financial planning can really be a help to you and can allow you to make charitable gifts that are very significant and that achieve your aims. Let's hop to the next slide and talk about how we choose the organizations that we're going to make grants to, because this is a question that I spend a lot of time on. People often come to me and say, how do I know an organization is doing what they say they're doing? How do I know my favorite charities are good organizations to support? And so we'll talk here about how you choose organizations. And then when we get to the next slide in a few minutes, we'll talk about how do you research those organizations to really know you're supporting what you intend to support. So let's start here. How do you decide what you want to support? Start with your own goals. Think about your charitable giving over the course of your life. Think about not just charitable giving in terms of dollars, but also the time that you spend in volunteer work, the specific talents that you have to contribute. Are there ways that organizations are doing things where you can partner with them and use your own skills and talents as part of your gift? Think about your social ties. Where is your community connected, and are there places that you can plug in and be of use? So start with your own interests, right? Philanthropy, again, is deeply personal. We all give to the things we care about the most. And so starting with what do I care about is a really important place to start. Then start to think about scale in a lot of ways. So first, think about where you want your impact to be felt. I've worked with many donors who have the ability to make gifts that have national impact, but who have chosen to focus their giving in a local way because they really believe that being able to see and feel the impact of their giving has some meaning for them. The National Institutes of Health published now a couple of successive studies that talk about the things that keep us healthy and connected as we age. And one of the things they singled out that gives us joy, that keeps us connected to our communities, is charitable giving, whether it's of time, talent, treasure, or social ties, right? It doesn't have to be money. But one of the things that keeps us connected to our communities and therefore helps us age in a way that is healthy and fulfilling is engagement with charitable organizations in our own community. So think about whether you gravitate more toward the local things you can see and feel and touch, or whether you're interested more in working on national priorities, or whether maybe you'd like to do a little bit of both. Then we start to think about organizations themselves. Nonprofits come in all kinds of shapes and sizes. There are well over 1 million of them in the country today, and the vast majority of them are small. But that doesn't mean they're all small, does it? We all have alma maters with big endowments that we could give to. We all have hospitals locally that have helped us and our families, but that also seem to have a lot of resources. So think a little bit about, do I want to invest in organizations that are large, where my gift might be one among many? Do I want to invest in organizations that are small, where my gift might not be one among many? And how safe do I feel about that? So think about what's the right scale for you. And think also about the scale of your donation, right? When you're giving $500, that's different than when you're giving $10,000. And so think about, as you're planning which charities are going to receive dollars from your donor advised fund, think about how big am I going to make my donations and how much impact are they going to have on the organization receiving them. Of course, every charitable gift has impact and is important to the organization receiving it. But depending on your own values, you may feel strongly that you want to be one of many donors, or you may feel strongly that you'd like to see a certain initiative through and you'd like to make some major gifts to make certain that it happens. So check in with yourself about both the size of the organizations you want to support generally. Do I want to support organizations that tend to be smaller or tend to be larger? And how does the scale of my own personal donations fit into that? Right? Of course, you want to understand what the organization does, right? You want to find some way to verify that it in fact does the work it does. And this is one of my favorite parts, right? You'll look at the annual report, you'll look at the website, you'll ask around in your community, and you'll try to figure out what impact exactly is this organization having on the lives of the people or the issue that it seeks to help. One really great way to assess that is to look at the quality of the organization's leadership. And here I'm talking not only about the CEO or executive director, but I'm also talking about any publications they put out, any thought leadership they do for the community, any ways that they are helping as advocates on issues that are of concern to a larger community. So try to get a sense for the quality of leadership. One thing you can do, and I find philanthropists are sometimes not quite ready to do this, and I want to encourage you that this is in fact something that you can do. You can call the organization that you've been giving to and say, I'd like to learn more about the programs. Could I speak with someone who can tell me a little bit more outside the development staff, right? Typically we're talking to the development staff, but once we start to make larger gifts and we've created a donor advised fund or another charitable vehicle that's going to be our primary way of giving, but it makes sense to get to know the organization a little bit better. If you can get 10 minutes with the executive director or CEO, take them and ask a couple questions about what they are proud of today and what they're looking forward to in the future and how they think the organization is going to get there, right? Do your best to really engage with the leadership of the organizations you hope to support and understand for yourself using your own critical judgment. You're a good judge. You have a good brain. You can use your own analytical skills to figure out, is what this person is saying, does it make sense? Does it seem like it would work? You don't have to be an expert in the field to assess those kinds of questions. So really assess quality of leadership. I think among all of these factors, in many ways, that's the most important one. Do we feel comfortable with the quality of the leadership? Do we believe that the leadership of this organization is going to carry forward and make a big impact over time? Now, there are a couple of concerns that always come up when we talk about choosing organizations to support. One of them that I hear quite frequently is I hear that donors sometimes believe that we're paying the CEOs too much. And I'm always disappointed when we have to have this conversation, largely because I think this is one way that the nonprofit world really has not evolved. And that's that, for better or worse, costs more to get expertise on the labor market these days. And to the degree that nonprofits are not hiring people with the expertise they need and the qualifications they need to solve what are really complex, challenging social problems, those organizations won't be able to get the work done. And what does that mean? It means increasingly we're hiring people who have great skills, who don't necessarily just come out of the not-for-profit sector, but who might come out of the private sector or out of government, who bring tremendous and important expertise to the table. And we have to pay the market rate to get them. And so the days when we saw a lot of volunteer executive directors or people who were happy to take a $10,000 a year salary, those days I think are long gone. And when we care about impact, we have to care about, are we hiring and retaining the right people to do this important work? And that means paying market rate for talent. So that's a new concern that I'm seeing, maybe the last decade I've seen come up a lot. The other one is, where does my gift go? Right? Does it go to programs or does it go to salaries? And for many people, it doesn't feel good to think about their gift going to salaries. And I want to challenge that a little bit and say that without people, without paying people who are experts in this work, we'll never get to have strong programs. We'll never have in our nonprofits the kind of infrastructure that allows us to really change some of these difficult social issues to make the impact that we want to make. And so my own personal view, having done this work for more than 20 years, is that I don't care whether a particular gift goes to program or salary. What I do care about is, do we have the right people to do the job? Is the leadership quality very high? Can I tell the work that I'm interested in is being done? And is this organization a good fit for me and my values? If it is, I don't care where in the organization my gift is going, because I know my gift is going to make the difference that I want it to make. So let's talk on the next slide about how we research some of these organizations we might want to support, right? Because many of us are going to want to know more than just what is on the organization's website or in the annual report. So I will tell you this, you can do some basic document review. You can start with the Form 990. That is the annual tax filing that nonprofits prepare. You can get it in a bunch of places. The IRS has an exempt organization search that you can Google for and put the name of the organization right into it. If you have been doing this for a while and you had given up on the IRS exempt org search because the search engine wasn't great, up until a couple of years, it wasn't great. It's much better now. I encourage you to go back to it and give it a try, because it's a very good resource to look at those Forms 990 and try to figure out, how does this organization work, and are they doing the things that I care about? The other good resource to take a look at an organization's Form 990 is Guidestar, just at guidestar.org. It does require you to set up a password, but just to see 990s, there is not a paywall there, right? You'll set up a password, but you don't have to create a membership. And so both of those two websites will show you the same set of information, right? They're the same 990s, they'll be identical. But it's nice to have a place to go and just read an organization's financials and see how it presents itself. I realize the idea of reading a tax filing can feel somewhat intimidating. And so I want to encourage you to look at a couple of places, right? The front page of the 990 is just lovely. They reworked it about a decade ago, and it's got a great comparison between the current year and the prior year. So you can see, what kind of a trend is this organization on? You know, an upward trend? Are they doing about the same every year? Or is it a downward trend? And if it's a downward trend, how comfortable am I with that? Is there a reason for that? Right? So you will find, as you start to read some of these 990s, that you'll have questions. And when you have those questions, you shouldn't feel that you have to resolve them on your own. This is the whole point of the development department, right? So after you've done your research, reach out to the organization, ask any questions that you have. I will tell you, there are a couple other things to look for in the 990. Here's a good one. Near the end, there's something called Schedule O. That's the narrative section. If there's anything unusual or interesting that requires explanation, it'll show up on Schedule O. Most organizations don't have much on Schedule O except their policies around board review of key documents and executive compensation. But when there is something interesting, that's where it'll turn up. So go ahead and skip to Schedule O near the back and take a look. And then I just want to make sure that you know that you can also ask your network, right? Focus on asking your own network how organizations do their work and whether they think that work is strong, right? Partners will be able to tell you if the organization is doing strong work. Lastly, an organization's audited financial statements are not always on the website, but they should be available to you as a donor if you ask. And so if you call an organization and say, can I see your audit? And they say no, that's a key in itself, right? Do we maybe want to focus on supporting organizations that are transparent with us? Probably. But when you do get an audit, sometimes it feels intimidating to read those if you're not an accountant, right? But let me tell you, audits are really interesting. I find that for me, the audit often offers me more information than the Form 990 because there's so much narrative in it. There's so much I can learn. So begin to take a peek at the audited financial statements for the organizations that you care about. I realize on the first read that they might seem pretty dense and difficult to figure out. If you have someone, either a tax professional or an investment professional in your life who can help you decode those, that's great. For our clients, I do a lot of workshops around red flag or red herring, how to read these two financial documents so that you can really understand what's going on in an organization that you support. But anyone, again, can use their own critical thinking skills and get through these two documents and get a picture of the organization, what choices it has made over time. Both of them are comparative in nature, so they give you 2 years to look at and you can assess trends. I think it's worth beginning to familiarize yourself with both of those documents. So let's skip to the next page and talk about how you can use your donor advised fund with your family. And this is going to be our last big topic before we hop into Q&A. And so I want to encourage all of you who have questions to please submit them. I can see we're getting some good ones. And please keep them coming and we'll get to as many as we can. So this is one of the great joys, I think, of the donor advised fund model. And that's that it's flexible enough to be a giving vehicle for your family, however you define family, right? I see people who are related and people who are not related to each other using donor advised funds together because they're so flexible. So frequently, I talk to people about how we use them as a family philanthropy vehicle. And they often ask me, in my family, I have some people who are young and some people who are old. At what age should I start to talk about philanthropy as a family? Right? What age should we start to talk about giving? And I just want to encourage you. I do frequently when I'm in person with people an exercise where we ask people just to self-identify. And I say, so if you were taught about giving in some way, if someone modeled it for you, mentored you, talked to you about it, stand up. And so usually almost the whole room stands up, right? When we're talking about a charitable topic, everybody has made some kind of charitable commitment. Everybody stands up. They learned it from somewhere. And then I say, if you learned it from a parent or a grandparent, please raise your hand. And I will just tell you in the first question, when I say, did someone model this for you? Did you learn it somewhere? 90% of the room typically stands up. Of that 90% standing, when I say, did you learn it from a parent or a grandparent? 75% of those standing tend to raise their hands, right? So what do we learn from this? People tend to learn about charity in families, right? We pass our own values on within our families. And so having a vehicle for family giving together is really just an extension of that sharing of values that we already are doing, and that helps create more charitable people on this earth. So when we say what age to start, it depends on what we mean by starting, doesn't it? We can model engagement with our communities our whole lives, and everybody around us will see it. But when we talk about giving specifically, typically it's pretty hard to engage little kids, right? If you have children or grandchildren who are under 5, you can talk a little bit about your charitable giving and model certainly your engagement with the community, but there won't be any deep conversations there. Once we get to elementary school age, in elementary and middle school, there are wonderful opportunities to volunteer with the young people in our lives. One thing I would say is that before about the age of 12, the idea of other people being in need is pretty frightening for children because they can't quite separate the idea of other people being in serious need and their own lives, right? They're not sure if this could happen to them. And so one of the things I often advise people with younger children in their families to do is start out with volunteering and start out in the environmental space, or start out with animals, or start out hiking a trail and volunteering to clean it up, or a stream, right? Think of something that doesn't necessarily expose kids to some of those big root cause issues in our society, things like poverty, homelessness, limited access to food, right? Food insecurity is pretty stressful for an 8 or 10-year-old. And so start with some of those broader issues that allow engagement, but don't necessarily confront kids with some of the sort of scarier pieces. How do you include them, right? If you're going to start with children or grandchildren, what do? Well, first you model. We talked about that, right? Secondly, you volunteer together, right? You do it together. And once you get past with younger people about the age of 12, that's the point where more serious conversation around your philanthropy can occur, right? I find that in most families, you can talk about your giving and share information about the choices that you're making, and even include younger people in the decision-making itself in some small ways, beginning in elementary school. But by the time you get to middle school and high school, that's a point where you certainly can challenge kids to begin to propose organizations that are consistent with your family's mission or with their own values. You can challenge them to put together a little overview of the organization and suggest a specific gift, and you can reward their diligence by making that grant from your donor advised fund. One of the big things that we see as young people age is that eventually they grow up and have assets of their own, and we start to wonder, is this donor advised fund really a vehicle for the whole family, or does each generation end up with their own donor advised fund? And that's really a question that's resolved differently in different families. Depends on your family and your own personal family dynamics. I sometimes see really interesting work where One generation of the family starts the donor advised fund, and other generations as they grow up contribute to it, and they all give together, which is a really neat model. In other families, I find that while there are many shared values, it makes more sense for each nuclear family unit to maintain their own giving vehicle, even though they may work collaboratively together. They may all get together at Thanksgiving, as many families do, and spend some time digging into what are the things we care about, what organizations did we give to last year, who do we want to give more to, and who comes off the list, right? Those might be decisions we make collectively as an extended family, but we might still do our giving out of our separate donor advised funds. So this is really something to begin to think through with your own family. That question about who should contribute is an interesting one, right? So frequently when we begin to work with the younger people in our family and they grow up, we start to wonder, they've been giving out of the donor advised fund with us all these years. Once they begin to be able to contribute to the donor advised fund, should we ask them to do that? And that's always an interesting conversation for families. What I see typically is where the donor advised fund has really evolved to become a family giving vehicle, and everybody has contributed to the choices about giving out of it. Often I do see adult children wanting to join together, and especially in early adulthood, if they're able, and contribute to a family donor advised fund. But typically what I see as people age is that once people get into middle age, and especially if they've created a nuclear family of their own, they tend to then create their own donor advised funds. It's interesting. These are family vehicles and can be used in a variety of ways within families, and they invite collaboration among multiple generations. One quick thought about grandparents and grandchildren. I think this is the secret weapon of donor advised funds. I will tell you, I've had many conversations specifically with baby boomer grandparents who have said, my values when I was raising my own children are different from my values now. And I want to share the things I've learned about what makes for a truly fulfilling and successful life with my grandkids. And I'd like to include them in my philanthropy. And so I find often when that happens, it's most successful when we eliminate the common enemy, which is unfortunately my generation, that middle generation, right? The generation that's both child and parent. And when grandparents and grandchildren work together on giving, when they work together to decide what are the issues that we care about, what kinds of organizations do we want to give to, when we make gifts that are big or small, how do we assess the organizations, know we're giving to the right ones, right? And ultimately choose organizations and amounts and make their grants and go on visits and volunteer and do this charitable work together. That can be hugely powerful for families and a wonderful way to share your values with the generations that come after you, to share your success stories and the success stories of the generations that were before you, so that those after you can hear them. One last word. It is possible to pass on a donor advised fund. Of course, we talked about it's not an asset that you own, right? But you can allow someone to inherit that advisory privilege that you enjoy having created the donor advised fund. This depends largely on what kind of an organization you set it up with. Some allow many different generations of successor advisors, and some allow a limited number of generations of successor advisors. But the way it works is you fill out a simple form and you say, once I'm no longer able or interested in managing my donor advised fund and advising grants, I would like someone else to do it, and you can nominate that person. And so there is a way to sort of pass these on, and especially if you've made this an effort with your whole family, it's pretty special to see it continue into the future and continue to do good. And especially where you've been able to talk with family about values and you found shared values, it can feel very gratifying to have a donor advised fund that continues on in a family. However, many times it makes more sense for family members to continue doing their philanthropy on their own after we finish with our donor advised funds. And so in lieu of successor advisors, we can always essentially create a beneficiary, a charitable beneficiary with our donor advised funds. And so if you don't feel that there's a successor advisor who makes sense for you, or if you feel that it's your donor advised fund and you'd like to advise the dissolution of every dollar in it, you can leave using, again, a form that your donor advised fund sponsor has. You can leave the assets remaining in your donor advised fund after the end of your life to any charity that you like. And that's, I think, one of the really exciting things about donor advised funds. You are able to make sure that every dollar that you contributed goes to the causes and the values that are most important to you. So let's hop to the end of this. I think we're at the very last slide here, and make some time to take some questions. I know we've gotten some very good questions in, and I'm eager to hear from Adrian about them. Okay, so let's see. We've got some great questions and I'm just reviewing them now. The first one is around what fees would be considered reasonable. And Adrian, I see you've popped up. Should we dig into what fees would be reasonable?
Yes, and I also want to say thank you. This was really informative, and I've learned a lot, and I think that you're really helping us think deeply about our giving and also strategically. So I want to thank you again for the presentation. But yes, we have a fair number of questions, and yes, we did get a number of questions about fees in a variety of ways. So tell us about fees. What's reasonable? What should people look for when they're thinking about setting up a donor advised fund?
That's a wonderful question, and one I hear all the time. And I just want to highlight one of the words you just used, Adrian, about donor advised funds, and that's the word strategic. It is, I think, such a great opportunity to be thoughtful about our giving and indeed to develop a strategy and to implement it and see what impact we can have on the world. So donor advised funds are a very useful strategic tool. So how do we think about fees? Well, here's the thing. Everyone who manages a donor advised fund for us is going to do a fair amount of administrative work. And so there will always be fees. And typically the fees are broken down into two categories, right? Where investment is possible. Some donor advised fund sponsors allow it and others don't. Typically there's a modest fee for investment of the assets, depending on what kind of an asset allocation you prefer and the time horizon in which you think your donor advised fund will be active. The bigger fee typically is the administrative fee. And what are you paying the organization that's doing the administration for? Well, essentially, it's to create a portal where you can input your suggestions, your grant suggestions. It's to review each one of those grant recommendations and make sure they're in compliance with the IRS. And also, it's to cut a check or reach out to the organization and get electronic banking information and make sure the dollars eventually get there. And at the end of the year, reconcile all of those grants and make sure that they, in fact, did go to their intended organizations and didn't get lost in the mail or somewhere along the way. And so typically you can expect to pay at one of the commercial donor advised funds somewhere between 40 and 60 basis points. That is 0.4% to 0.6%. And if you are at a place that offers more service, right? And by that, I mean a philanthropic advisor, someone like me who sits with you, helps you figure out what you want to give to, maybe does some family meetings to help your family get organized. Community foundations tend to offer some of those things. Wealth management investment firms do sometimes as well. There, you'll typically pay a little bit more for service, and that will be more like 1% or 1.25% annually. So you'll see fees really range. And I think it's important to think about, what are you looking for, right? If you do want help with your giving, you'll pay more for it, but it will be very valuable to you. If you're certain that you don't want help with your giving and you're looking for a pretty stripped down experience, then I think it's important to know that too. So one of the first questions to ask yourself when you're thinking about fee is, what do I really need to get out of this?
Yeah, it's like you were saying, this is a very one-to-one situation. Each person's going to have their own goals, and charity is very personal. So one clarifying question from the audience, when you were talking about taxes and sort of contributing to the DAF, can you explain why you said cash is only 60% deductible? Is that a rule? So somebody, I think, wants to clarify about the cash element.
It is a rule. What a good question. So, and this is quite interesting. Gifts of cash to public charities are regulated in terms of their charitable deductibility. We had an interesting opportunity during the pandemic that gifts that went directly to public charities that were not donor advised funds were actually for 2 years deductible at up to 100% of your AGI, which was a surprising moment and really interesting from the historical perspective, because we have not seen that much deductibility for individuals in gifts of cash really in my career. However, donor advised funds are in sort of a special category. And even though they're in public charities, they were never eligible for that expanded giving limit. Right now, you can deduct up to 60% of your adjusted gross income, your AGI, on your annual federal income tax. And if you've given more than that 60%, you do have a 5-year carry forward, right? So if you happen to gift more than 60% of your AGI, you don't lose the excess. You have 5 additional years to spend it down against income in the next 5 years. And again, here we're just talking about federal income tax and deductibility there. The state situation varies. In some states, there is charitable deductibility, as in Pennsylvania. In other states, there's no recognized charitable deduction, as in New Jersey, and you pay income tax regardless of what you've done with the dollars. And so it's important to have a conversation with your tax advisor, especially if you're planning to make a big gift, about, given the regulations around deductibility, am I using the right asset? For example, if you were to gift appreciated stock, you might get a benefit from a tax deductibility perspective only of 30% of AGI, but because of the capital gains savings, it may be worth more to you. And so this is a place where go back to your financial advisor, your financial planner, and work through, given the rules about deductibility, which one of these assets is most advantageous for me.
Great, thank you. We've gotten a question that I think is a little complicated, but I think it's a good question to bring up specific to DAFs, which is it possible to give to charities outside of the United States from your DAF?
What a good question. So there are a bunch of ways to do this. If your DAF is very large and you're very focused on giving to charities outside the United States, and those charities do not have a US fundraising arm, then there are 2 processes that you can go through to certify essentially that the organization you're giving to is similar to a U.S. charity, and that the funds have been used in a way that the IRS would find to be charitable. But those require typically you to hire an attorney or another vendor, and that process tends to be pretty expensive. Proving that expenditure responsibility piece tends to take a lot of time and effort on the part of the attorney involved, and so it can be quite expensive. And so if you want to give internationally, I find that one of the most efficient ways to do that is to look for organizations that have a U.S. fundraising arm, or where the charity that you care about does not have a U.S. fundraising arm. Perhaps you can help them find an organization in the U.S. that would be a good fit for them, that would be willing to be a fiscal sponsor. And a fiscal sponsor is just an organization that collects, typically for a fee, donations to another charity and certifies that those donations are used in a charitable way. And so typically that will be easier than going through the expenditure responsibility process for every grant, especially if your grants are not enormous. There are a number of vendors who are US based who will help you with very large grants. If you're planning to make a grant of several $100,000 or more to a non-US based charity that does not have a US based fundraising arm, there are vendors that can help at that scale. And so if you are planning to do something like that, again, check in with your tax advisor, check in with your investment advisor, look for connections to some of these organizations that can help you smooth the way so that that remains charitable and you do get the charitable deduction for it.
Great, thank you. One person has shared that they turned over their advisory rights to a sponsoring organization, and they're wondering if they can get their rights back. So I'm curious, is that a possibility? I would imagine it would depend on who you have the DAF with.
Yeah, so that's a really interesting question. Here's a good example. So I'm reminded of a particular story, and I will anonymize it, but it was really interesting. It was a family that set up a donor advised fund and then moved abroad. And so their concern was that they really cared about this community. It was where they'd raised their kids. It was where they had built a business. It's where they had put down deep roots. But they lived pretty far away and they weren't able to stay in touch with the community. And so they left us their donor advised fund. There was a fair amount in it. And they said, can you use this for your community programs? And we had wonderful programs that were focused on education and making sure that kids thrived in the community. And so it was a great fit. They weren't anticipating moving back, but they did. And they came to us and said, could we have the donor advised fund back? And I'm wondering if this is a similar situation here. That's really a matter of policy, depending on the ways that the policies were created for each individual donor advised fund sponsoring organization. So it really depends, but I would encourage you to go back to the organization and say, something's changed for me. I'd really like to be able to advise my donor advised fund again. What do we need to do to get there? And I do find that organizations that hold donor advised funds tend to be very sensitive to the interests and needs of those donors who gift to them, because of course they won't grow if more people don't donate to them. And so I do think they'll be interested to hear what has changed for you, and they will at least be willing to entertain a request to take it back. Whether you would be successful or not, I couldn't say, although I will tell you that in that instance, I talked about the family was successful in taking back their donor advised fund.
That's great. That's a good example and very relevant to that question. So we did have a policy type question, which is, do you see donor advised fund regulations changing, and sort of what trends, if any, are on the horizon that our donors should be aware of?
So Chuck Grassley has been trying for, decades to regulate donor advised funds more. And although we've had proposed legislation in the past, none of it has garnered as much attention as a piece of proposed legislation today, the ACE Act. And I do think that in the future, we will see more regulation around donor advised fund. And I think that's going to come in a couple of arenas. One, as many of you know, private foundations have a required 5% annual distribution that must be made. Right now, they're allowed to make some of that distribution in things like staff costs and travel costs, but it is designed to make sure that money is going out to charitable institutions every year. I would expect that in the future, we would have a similar requirement for donor advised funds. That is in the proposed ACE Act right now. Not a lot of activity going on with the ACE Act. It may not make it through the process this year, but I do expect that eventually in the next 5 years or so, there will be legislation that is successful around that. I also see some concerns around deductibility of contributions, depending on how long the contributions are going to sit in a donor advised fund. And that's an interesting question that the ACE Act also proposes to address. What I am starting to hear is a sense that there may be more advantageous tax deductibility available for donor advised funds that have a shorter time horizon. That is, if you put money in your DAF and you intend to spend it down within 10 or 15 years, that may be more deductible than if you put money in your DAF and you intend for your grandchildren to spend it down in the next half century, right? So none of those changes have come to fruition yet, but they have been many years in the making. I think the community, the charitable community at large, accepts that there will be some more regulation on donor advised funds. The other last piece I want to flag is I do expect that at some point there will be regulation around those advisory rights and how far they extend. Things like being able to make investment choices, I think, may not be options for donors in the future, although they are today. So one thing that you might do, if you're thinking of starting a donor advised fund, but you have some concerns about how things will change in the future, is remember, one, the deduction that you get today is the deduction you get to keep, right? No one can come back and take that. And so we understand what the rules are today. They're fairly attractive for donors who create DAFs. And so if that's something you want to lock in, do it today. If it's something you're thinking of doing in the future, talk to the donor advised fund sponsor that you've selected and say, what do you expect to come down the pike? And how can you help me strategically deploy my intended charitable capital in a way that makes the most sense for me based on what we know today and our evolving knowledge about future regulation, right? Right now, we kind of know what direction it's headed in, but we have no idea of the time frame other than that it's sometime in the next decade.
Definitely something to keep an eye on. So we've had a couple people talk about the question around minimum giving amounts. So there's one particular person who's saying that her DAF has a minimum giving amount of $100, and she's wondering if all DAFs have minimums and if it's possible to move from one DAF to another. So could you transfer assets from Fidelity to Bryn Mawr Trust, for example?
So increasingly many DAFs have minimums. And I will tell you a little community foundation story. Many years ago in the community foundation world, many of us were doing studies to figure out how much did it cost us to make one grant. That was, what did we invest in terms of systems and people in the process between when a donor recommended a grant and when the check left our building. And what we discovered in general, and it was interesting, many community foundations did this. We aggregated data. It's national aggregation, right? So we're dealing with high cost of living areas and low cost of living areas. But the average in the mid 2000s was that we were all spending $12 on one grant. I imagine with the way that salaries have gone up and also the cost of technology has gone up, that's doubled or tripled today. And so that's the reason that you see those minimum grant requirements. It doesn't make sense for the sponsoring organization to spend time and money and staff effort on small grants, largely because they end up spending so much money to put out our $25 grant. And so that is a change. It's funny because I was just speaking with a family recently where different generations had really different ideas about what was the right amount of money to give to a charity. And the oldest generation, even though they were a wealth creator generation, they really have created quite a lot of wealth, still thought about how much money they put in the church offering plate when they were children. And that was sort of a baseline for them for charitable giving, even though it was 60, 70 years ago, right? And the world has changed a lot since then. And so for some of us who are used to making smaller gifts, it's difficult when we come up against those limitations. But the organizations are doing it to try to make sure that they're not spending a ridiculous amount of time, energy, and capital on smaller gifts and instead can focus on making impact through some larger gifts. The question about moving a donor advised fund is a good one. And frequently you can. So again, this is an issue of policy. Different donor advised fund sponsors will have different policies, but right now, the majority will allow you to grant the total balance of your donor advised fund to another public charity, which could be a donor advised fund. The challenge is that some of them are sort of figuring out that that's how we indicate our dissatisfaction and we're going somewhere else. And every once in a while, I do trip over one that does not allow grants to another donor advised fund. So that's something to ask about when you set up your donor advised fund. And if it's very important to you, you'll sign a donor advised fund agreement when you set up your fund. So if it's very, very important to you, add that to the agreement that you retain the flexibility to move to another donor advised fund if this one does not work out for you for whatever reason. And I will say there are a lot of legitimate reasons that you might want to transfer, right? We're not always talking about people who are upset with the service. A lot of times from the community foundation world, we were talking about people who used to live in one place and moved and felt really deeply that local giving was high impact and they wanted that local feeling and they also wanted advice from someone who was on the ground locally. And so it made the most sense to transfer their donor advised fund to a community foundation in their new community when they moved.
Great. Well, thank you for that. I do just want to highlight, we're maybe going to get to one or two more questions. So Natalie's going to put the survey link in the chat. If you can please give us your feedback on the survey, that would be fabulous. We will, like I said earlier, be sharing the recording if you had to step away for any part of the program. So we have gotten a few questions about the questions specifically around estate planning and DAFs, which you touched on a little bit, but I kind of want to come back to a point that you made earlier, which is that some people are saying, oh, if I'm setting up a DAF now as a part of my estate plan, is that a smart idea? It seems like, based on what you're saying about legislation, that may not be the best vehicle for somebody to use if they are maybe, let's say, in their 50s or 60s, there could be some legislative changes. So would you recommend that somebody sets up a DAF with the intention of having it be a part of their legacy plan, or is there a better way to go about legacy planning and DAFs for somebody who is charitably minded?
So there's one tremendous strength DAFs have that we didn't get into today. And that's the fact that unlike when you make a will, where if you change your mind about your charitable beneficiaries, you have to pay an attorney to update the document. And it's hard to remember to do that. And sometimes we forget, and sometimes we forget for long enough that we don't do it. And the wrong organization might get the funding. The nice thing about donor advised funds is that if a donor advised fund is the repository of your estate and you have future instructions, you don't have to pay a lawyer to do that. All you have to do is give the donor advised fund sponsor a letter or a form indicating your instructions, right? So that's the upside in terms of estate planning. So flexible, so inexpensive. You can change it at any time. All it requires is a form or a letter. Sometimes you can do it online in 10 minutes. Otherwise, you can sign a letter and email it over to them. Right, so that level of flexibility, I think, is really attractive this is a place where good estate planning is paramount, right? My own personal crystal ball can't see to the end of my lifetime.
Right.
So I don't know how my own donor advised fund is going to be part of my estate plan. What I do know is that staying connected to my estate planner is really helpful in making sure that I make the most of that planning opportunity. And so what I would say is donor advised funds are really easy to set up. They tend to be very inexpensive to set up. Frequently, if you have testamentary intent, that is a whole bunch is going to flow in after you're gone. It really costs you nothing to set them up because you set them up and they're empty. And so if this is part of your estate plan, there's no reason not to set it up today and not to make sure that the organization that's sponsoring the DAF has your instructions, right? That's the most important thing, is if your estate plan today calls for any asset to flow out of your estate into your donor advised fund, you need to make absolutely certain that the organization receiving it knows what to do with it. Whether it's that your successor advisors are going to be in charge of it, or whether it is that you're going to send it to WHYY immediately, right? They just need instruction. And so that's an important piece of your estate planning that is going to fluctuate over time. We know that there is change expected on the horizon in terms of estate planning, even as soon as 2025. And so while we can't do anything about the changes in all kinds of estate planning topics, what we can do is make sure that our estate plans keep up with those changes, which is staying connected to our estate planners. And we can make sure that our expectations and directives are well understood by every person acting in them. So that was not a yes or no answer, but hope it was helpful.
No, it was wonderful. I do have one final question that is, I think, very interesting, but I think it's an important question, which is, do DAFs ever get uninvested or lose value after you put the funds in?
Certainly, like any other invested asset, they can. And so, that's one of the things to think about when you make an investment choice for a DAF is, do I really want these funds to be invested, or am I going to spend them down in a short enough period of time that they'll mostly maintain their purchasing power? And I'd rather they just stayed in cash and available to me all the time. So that's where sitting down, you talked about being strategic, Adrienne, that's a good word for this. That's where sitting down and making some plans about how soon am I going to disperse these funds and being strategic about where and when they're going to go will really help you make that investment decision.
Great. Well, thank you so much, Elizabeth. This has been phenomenal. I look forward to sharing out this recording with everyone. And of course, this will be accessible on YouTube as well. So if you have others in your community that would like to watch this fabulous presentation, feel free to do so. From all of us at WHYY, though, thank you so much, Elizabeth. I hope that you can join us for a program one day at the studios. But until then, you have our deep gratitude.
Thank you so much, all of you.